likely, if you've ever had a job in Australia since probably the 80s or 70s.
Late 70s.
Yeah, you will have a superannuation account. And today I'm joined by John Pidgeon from the This Is Property podcast. We're going to go through and detail superannuation. We'll do I'll say an intermediate look under the hood, because I know, John, you're smarter than a doormat, but not as smart as a fifth grader. So take that. Whatever. All I'm saying is, where it's not going to be really basic, it's not going to be really advanced.
Somewhere in the middle, Glen.
Somewhere in the middle. And the middle common ground is usually healthy. So I've prepped a presentation. These presentations, when we do them, John, it keeps us on track with what I want to cover, because the way I teach is kind of building upon knowledge.
Layers.
Yeah. So basically,
start basic and work our way up.
That's right. And then turn it up to 11.
Yeah.
We'll put in the show notes of the actual podcast, if you want to see the presentation, it's on YouTube. And yeah, save that, watch it later. But should we get into it, Johnson boy?
Let's do it.
So this podcast is brought to you by Sphere Home Loans. Now, we believe that if you're going to get a mortgage, you need to get a mortgage through a mortgage broker. It's a no-brainer, isn't it?
It is. Yeah, look, it's we're in the 2000s and 25s. So maybe 1980 or 1990, we were having a cup of tea with our bank manager. We've progressed from there. And we're looking across 25, 30 lenders maybe now. I think there's like 78 lenders in Australia, I think. Yeah. Made that up, but it's somewhere near there.
Well, there's a lot of options.
There are a lot of options, and it doesn't cost us anything for them to do the legwork.
No. The bank or lender will remunerate the broker, because they're outsourcing the application and the gift wrapping and all the client acquisition costs. So they just pay the mortgage broker, no out-of-pocket cost. Sphere Home Loans, they've worked with us for many years, and they've helped many of you listeners out there. So let's get into it right now. You're listening to Money, 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 or as the regulars like to call us, M3. Everything discussed on the podcast is general advice only, which I'm licensed to give, and details can be found in the show notes. My name's Glen James, former financial advisor, now podcaster. I host this show and a show called Retire Right. I've also got a book called The Quick Start Guide to Investing, which you can check out wherever good books are sold, or there's a link in the show notes. Otherwise, thanks so much for listening today. Now on with the show. At the start, John, did you have any high-level comments about, like, you haven't really seen the presentation. I've shown you an overview of what I'll get into.
Standard recording procedures.
Yeah. My standard MO. But I think I've come from a financial advice background. Yeah. I'm, like to think I'm in the weeds a little bit more on some financial products than you. And I think it's really good, while you know what day it is, there might be some things that you will ask that someone else might be thinking.
For the audience. Yeah. So I think, like, when you look at superannuation, a lot of people, especially early age, think, well, I can't access it till I'm 60-ish, so I'll just let it do its thing, and often not ignore it, but just it trickles along in the background. I'll wake up when I'm 40 or something and worry about it. So I think it needs more attention than that. And there are, as we'll go through, many benefits. And obviously it's the biggest tax haven, isn't it?
Yeah. It's a legal tax haven in Australia.
At the minute.
Yeah.
Hopefully nothing changes in that space.
Well, it probably will, but I think we know that it will always be more tax advantageous for the run-of-the-mill garden variety Aussie to use superannuation for long-term wealth accumulation.
Yeah. And I think it's also important to understand, yes, my money's going into this thing called superannuation, but where is it actually getting invested? So that's important.
All right. Well, we'll get into the old Prezi tea. So, look, eligibility. There were questions in the Facebook group about who can have a super account. You basically have to be an Australian resident. Like, you don't have to be a citizen. You could also be here working for a few years and go home. So pretty much anyone here can have a super account. And we'll get to it kind of in the coming slides, but to get money into super through an employer contribution, so that mandated 12%, you need to be over 18 or earn more than $450 a month, and then your employer must pay super, okay? If you are under 18, you must work for more than 30 hours per week to be eligible. Now, this one here, so that's kind of the tax efficient, we'll say, at the moment, the employee contributions, which go in pre-tax. That's one way to get money in. The other way is through personal contributions, which we get paid, we have that money in our bank account, then we transfer that money in. You can pretty much be any age to set up a super account. So some people say, oh, I've got kids, I want to set up a super account. What do they? Well, they basically, you just need a tax file number for your 5-year-old, and you need to find a super fund that will allow an application in. Some of them won't do it, but by law, if a 5-year-old gets their tax file number, you can set up a super fund for them, okay? And anyone under 75 years old can put money in through a personal contribution. Now, if you're age 67 to 74, you don't need to meet the work test anymore. However, that's for the non-concessional post-tax contributions, but the test applies if you want to have tax deductions. So most of the audience here is well under that, but that was just some housekeeping. Okay, so where does super sit? And this slide, and a lot of people don't realise this, John, but your personal estate or your assets that fall into your will, it could be a house in your name, it could be your bank accounts, could be your car, investments in your name, an investment property in your name, your personal belongings, all that stuff, if you die, your estate, aka potentially your will govern what happens to those assets. It's important to note that superannuation is a trust, and you must tell the trustee where to pay the death benefits, because superannuation falls outside of your estate.
And if that's not nominated, what happens?
Yeah, it's a good question. The trustee will use their own discretion.
So choose wisely.
Choose wisely. And we'll talk about beneficiaries later on, but it's really important to note that, your superannuation, and it's the same with the family trust. It sits outside of your own estate. An investment bond sits outside of your estate. So, but then again, for example, the house situation, if you're married to Amy, your home is likely in joint tenants. So if you die, your share of the house bypasses your estate and just goes direct to Amy. So there are carve-outs for different things here. Yeah. But, strictly speaking, super does not form part of your estate.
Cool.
Any questions, young one?
I don't think I've got too many questions there. It's pretty straightforward, isn't it?
Yep. All right, getting money into superannuation. 2 broad ways. The first way is the concessional pre-tax contributions. So a concessional contribution. The annual cap is $30,000 per year. Now, this $30,000 concessional cap is made up of what your employer puts in. So, for example, if your employer put $10,000 for a financial year into your super fund, you will have $20,000 spare in that cap. Before 2020, I think 17, 18, 19, around, I forget at the time, there was a change that you could use the unused concessional caps. So if you had 5 years running of $10,000 going into super and you sold an investment property, you could, in theory, 5 times 20, $100,000, you could move in one financial year $100,000 into superannuation, claim that $100,000 on your own tax return, so it's a tax offset, and the super fund pays the 15% tax if your account is under $500,000.
So that still occurs today?
Yes.
Right. So the question is for someone in their 20s or 30s that's listening in today, it's like, well, should I be maxing out? Because you need to be, rough maths say you might need to be on over 200,000 for that 30 to be capped out by the employer.
Yeah.
So do I concentrate on that? Right. Now, maybe a story for another day, but I've got so many other things I want to be doing outside of super as well. So people can become maybe not disillusioned, but it's like, gee, I can only take my money so many different ways.
Yeah. And we will get to it, but broadly speaking, super is the most tax-effective environment to store wealth for the long term. But if you need that wealth before age 60, you don't put it in.
Yeah.
So, and we'll get to that as the conversation progresses. The next way to get money in is after tax. So they call this a non-concessional contribution, and the annual cap is currently $120,000 per year. You can actually use 3 years, bring forward in the one go, and put $360,000 in. Or you could do 120 in June, and then in July, then you're 360. So you can be a bit strategic to get more money into superannuation.
Okay. So our concessional is 5 years, our non-concessional is 3 years.
Yeah, but the concessional looks backwards at what hasn't been used, and the non-concessional lets you pull the $120,000 a year forward. It's important to note every few years they index. So, you know, in a couple of years it might go up to 32,500 or something like that. I'm quite sure it indexes by $2,500 when that threshold hits. Again, not too relevant in this intermediate little session. Okay, so this is just a little bit of a diagram for those who are watching on YouTube, and we'll try and explain it for those driving. You'll see here we get paid our salary. Our employer puts 12% of our salary into super. There's 15% tax that gets taken off as it enters the super fund. So that's called a contributions tax. Then if we, got our salary, we take our tax away, and if you're earning more than $45,000 a year, that tax rate is 30%, and then the money goes into your bank account. So a couple of things here, John. If, for example, you had that $10,000 that your employer put in, and then you had a spare $10,000 that year that you wanted to save for the future, it would just kind of go through this same mechanism. You could tell your boss to salary sacrifice, a couple $100 a week. Again, it would go in less 15% tax. And the thing here is 15% tax is less than 30% tax. Okay?
Half.
So that's why it's, an incentive to save money for the future and pay less tax. Now, what you can do as well, at the end of the financial year, you can not salary sacrifice, but just put $10,000 in before the end of the financial year into your super fund and claim that as a personal contribution. So on your tax return, you'll put, yes, I put $10,000 into the super fund. I need to offset my tax by $10,000, and you need to let the super fund know that this is a tax-deductible contribution, and you'll log in and tick a box intent to claim, that you intend to claim this $10,000 on your tax return, and then they will take 15% tax off that, or $1,500.
So this is really a conversation that you're having with your accountant, ideally prior to June 30 each year.
Yeah, if you're not salary sacrificing each week. So both roads lead to Rome, but there's a bit of flexibility here. Maybe if you're self-employed, or you just choose that, well, we're just going to build wealth throughout the year, leave money on the offset account. Yeah. At the start of June every year, we'll have a look at our caps. We'll have a look. Yep, well, we've got $10,000 free. Well, let's put $5,000 in super, and let's put another $5,000 in investments in our own name.
And worst case, if you didn't get around to it before that June 30, then you can go back any case that 5-year period with the concessions.
Well, and this is where you have to be careful. If you don't match it this year, you'll have to, like if you're a week late and it lands in the super account on the 1st of July, it's going to be in the next financial year.
Yeah.
Now, the trick is you've got to just look at the last 5 years. That 5 years ago, that could have a higher gap. Yeah. You want to use that before it rolls off.
Yeah.
So,
and the gap's changed as well. Oh, sorry, not the gap. The max contributions changed as well.
They index every few years. So anyway, let's move along. So the tax rates, again, in super, it's 15%. So concessional contributions go in and they're taxed 15%, and any earnings within the super fund is taxed at 15%, where if you had shares in your own name, any earnings would be taxed at whatever your tax rate is. So pretty simple there. When you're over 60 and stop working, if you wanted to start an account-based pension, you can move up to $2 million into the pension account and earnings will be taxed at 0%. So you can effectively have money grow at 0% and withdraw the income tax-free.
Pretty cool. So again, getting into the weeds a little bit for a minute is, well, okay, I go and put 10,000 into shares in my own name.
Yep.
And I get taxed at my tax rate,
yep.
which is, let's say it's highest, like 45, right?
Yep.
That tax, obviously I'm paying more than if it was in super, but I want to access that prior to after selling those shares, so I don't want to put it in my super because I'm only 30.
That's the trade-off.
Right, I'm 30 years till I can access those gains.
Yeah.
Yeah.
So that's...
But I'm paying tax because financially you'd say, well, why wouldn't I be taxed at 15%?
Oh, super. So the question is often, should I pay down the mortgage or invest? Over a long enough period of time, minimum mortgage repayments and investing will generally have a net positive.
Yeah.
Then we go, okay, do I invest in my own name or in super or pay off the mortgage? You do it in super, it will be 1,000,000 times more tax efficient because of the internal tax at 15%.
Yeah.
But it goes back to that trade-off. What are you prepared to sacrifice and build your future with?
It's also good from the point of view of, I put it in there, I can't access it. That's a good thing for my personality.
That's right. Yeah. So again, personal finance, personal. It is a trade-off. Okay, so I don't want to get into the weeds too deep here because of the intermediate nature of this presentation. But effectively, inside superannuation, there's two broad, they call them tax components. There's taxable and tax-free. Now, this can get crazy fast. The taxable portion can actually have taxed and untaxed, but we'll just forget that for now, everyone. But effectively, when your employer puts in their contribution, your 12% superannuation guarantee, it falls in the taxable component. If you put $10,000 post-tax into your super fund or up to that $120 a year, that goes into the tax-free component.
Because you've already paid tax on it.
Because you've already paid tax on it. So that's just a bit of a 101 there. So, John, you might be thinking, that's all well and good. Well, how do I invest? Well, we're going to have a look at investments right after this.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Sky Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at sky.com.au. That's skye.com.au, and they'll point you in the right direction.
Okay, we are back. investments. So we've got to remember superannuation is just a tax structure, or a tax structure rather. So what most people will have their super in, and this is just from the ART website, full disclosure, ART have worked with us before, so why wouldn't I use them as an example? They haven't paid for this, but, if we have a look here, most people will have a portfolio that has a blend of assets, right? And it's important to note that in the super world, there's like almost $4 trillion of a super in Australia. We're on track to be the second biggest retirement pool in the world. The trustee and / your super fund, they will manage the money, do all the tick boxes and all that, and then they'll also invest the money for you, the member, and you can choose what you want to invest in. But I just wanted to park here and show a couple of examples. And whatever super fund that you're with or you're looking at, their website will be similar. It will tell you potentially the investment options they've got, the suggested hold time or the time frame. It will tell you the fee, and we'll get to fees shortly. Over the last 10 years of growth, when you see returns in the super world, everyone, it's after fees and after taxes, okay? So in theory, 0.79 over 10 years for the high growth option, you could add 0.7% to get the real return pre-fees. And you can see here how it says retirement income accounts.
Yep.
So because accumulation account is the account that's taxed at 15%, the same investment option in the pension account, which had 0% tax, did 9.61%. Okay, so you can see the difference there. 9.61 take away 8.79. So there's probably 0.8 in tax.
Yep.
So yeah, you'll see all this stuff on most sites. You'll see here their asset allocation, what they've got allocated to Australian shares, international shares. Now, in the super world, it is a little bit different. Unlisted assets and alternatives, that's going to be things like shopping centres, it could be toll roads, it could be alternatives, could be some private equity company. So when we have a look here,
based on my last trip, I wouldn't mind investing in toll roads.
Really? Yeah.
Outrageous.
Oh, yeah, it's expensive. So basically this fund, it says here, the high growth performance, if you want a diversified portfolio with around 85% of growth assets. So if we have a look here, there's probably about 65 in Australian and international shares. There's probably 20% of this unlisted and alternative here that is considered growth. So they might have some assets that are infrastructure assets that are considered defensive because they really don't change in capital nature. They're just, pay your revenue. So you'll see here with the super funds, it will tell you the standard risk measure. They reckon between 4 to less than 6 years, this high growth option will see negative returns in any 20-year period. It will tell you the investment objectives. So they really want to target 4% plus CPI. So if we have a look at if CPI is 3%, that's 7 in total. Well, we know here they've smashed that objective over the last 10 years because it's 8.79.
Okay, so this is an example in the high growth column. Where can we go with that? Would you say high risk is riskier?
Well, by the definition, higher growth is higher risk. And higher growth, we need to hold longer to cater for market cycles.
So someone in their 20s and 30s could easily say, yeah, give it
I think
growth.
If you're under 50, there's a strong argument that you need to get to, you need to understand this more and get to maybe an 80% growth. Because even if you're 50,
Yeah.
you've still got 10 years before you can really access the money.
Yeah.
And if the minimum hold time is 7+ years, well, it's time to get educated. It's time to understand. There could be some strategies, and we'll cover this later because it's going on the scope of what I want to talk about. But there could be some strategies where if you're 50, you might put the money in high growth and all new contributions just go to cash or So
in this example, we're looking at about 97% high growth. Cash and fixed income, you'd say, is a low risk?
No, because there's going to be 10% of the unlisted assets and alternatives that are considered defensive.
Where does it say that?
Well, it doesn't. I'm just kind of working out. They say that this portfolio is 85% growth. See that there?
Gotcha, yes.
And then here, if we add 30 Australian shares, 33 Australian shares,
65,
gives us 65. The 20%,
gotcha.
It can't come from cash or fixed income.
No.
So there's 20% coming from here, which is the unlisted assets and alternatives.
Okay, so if I want 90%, for example, then I'm going to very high growth.
Yeah. So there may be a fund that has an asset allocation to 90%. And actually, a lot of people say, if we have a look at this next slide, we are doing an episode. It probably will be up, if not in 2 days' time, right after this, on self-managed super funds. In fact, I think it pretty much will be. And we're just going to go through, and one of the common things is, well, I want to invest in ETFs, so I need to get a self-managed super fund.
Yeah.
Well, you don't, because even here with, again, ART, and every fund will have these options, you can choose an Australian shares index option. So that's 100% of your investment would go to Australian shares. And you'll see there that it just tracks the return of the MSCI Australia 300 index. So,
but I suppose where they're going with that is they don't have full control of where that actually goes.
Well, if you bought an index fund that was VAS, so Vanguard Australian shares, that invests in the top 300 Australian companies listed on the Australian Stock Exchange. You set that up in your personal account, in your app and all that. People are like, well, I want to set up a self-managed super fund so I can invest in ETFs. Well, if one of your ETFs is going to be VAS, go to your current super fund. This tracks the same benchmark, basically, as VAS.
Yeah. So if you've got one ETF that you want to concentrate on, go for it.
So what you could do, you can see here the fees cheap because it's an index fund. You could select in your super fund, I want to invest in the Australian shares 50% and 50% international shares. And what you can do, and I've put this in here because people want to build their own portfolios in their super. You really don't need a self-managed super fund. You can do that with most funds. So if we go international shares, you'll see that the benchmark is the MSCI All World ex-Australia. So that's equivalent-ish to a VGS. So you can get the exposure that you can outside in ETF land with your current super fund. This one here on ART, these are some of the individual options that you can use. Australian shares index, international shares, hedged, unhedged, listed property. So you might have VAP as an ETF in your own name. If you had a look here at the listed property, I haven't got it up here, it would actually show you what it tracks. And it would be, I can tell you now, very similar to that of the VAPs. If you want to list in their unlisted pool, you can do that. And then they've got bonds and cash. So all that to say, most trustees and most super funds have really a decent amount of flexibility.
Yeah. So the obvious question when we look at that is, well, I might be sitting outside of my super investing in ETFs and choosing how much money I'm putting in each month, dollar cost averaging different ETFs. I might have 7 ETFs set up. am I looking at that and saying, well, okay, because I've got that outside of my super, I'm mixing it up inside a super, or am I just staying consistent? Like there's no one size fits all, of course, but how does someone need to get that into the weeds about it?
I don't think so. I reckon most of the pre-mixed options with most major funds, they're around the same cost. And you can have a look. Actually, coming up on the This Is Investing podcast, a lot of people always ask, well, what portfolio percentage should I use? I've prepped an episode to record that I look at most of the top Australian super funds, look at their asset allocation, and then I've built my own portfolio based on averaging out all the top fund pre-mixed options.
Right.
And, very interesting, the outcome. So I think a lot of the pre-mixed options are fine because we know if, investing works, portfolios work, people don't.
Yeah.
And, if you did want to invest in 50% international shares, 50% Australian shares, and I'll show you here in a minute, John, the fees are cheap, the performance is decent looking back, but you probably won't be able to stomach a downturn.
No.
Where the premix options have unlisted property, they've got infrastructure, they just will give you a smoother return. So I don't think people need to overcook their superannuation investment choice. So let's have a look at fees now. There are basically 3 types of fees in most retail or industry funds or public offer funds available. There is generally a dollar-based admin fee, a percentage-based admin fee, and then a percentage-based investment fee. Okay? So if we have a look here, I've just put a small example together. With ART, the admin fee is $1.20 per week or $62.40 a year. The percentage-based admin fee is 0.1% of your balance, regardless of what it's invested in. And once you've got over $500,000, it caps out at $500 a year. And then they've got the investment fee. So that is the fee for the high growth option that we had a look at previously.
Right.
So I want to show people here how to calculate your superannuation fee, and I'm going to walk you through it. Remember, fees aren't everything, but they're something, and it's good to know. You first have to annualize the admin fee. So we need it to be $62.40. Then we want to get the dollar amount of the investment fee and the admin fee. So if someone here had $63,000 in their super fund, it's a $62.40 flat fee. The percentage fee of the admin is $63. The investment fee of 0.7% is $441. Remember, that's not taken out of your account. You won't see that in the statement. It's taken out before they give you the investment return.
Gotcha.
Remember that table I showed you with 8 point whatever percent? That's after the 0.7 had been taken out.
Yeah, but not the admin fees.
But not the admin fees. So what you basically do then is we add the $3 figures together, which is $553.50. And then I've written this out if you want to take a screenshot or remember this. It's really easy to put in your calculator if you're, mathematically challenged like I am. $553 divided by, so your total fee in dollar terms.
Total balance.
Total fee divided, total fee divided by the balance.
Yep.
Divided by $63,000, it will give you a 0.0009, blah, blah, blah. Mm-hmm. Then just press times 100 in your calculator and it'll round it down to 0.90%.
And those 3, the $1.20 per week, the 0.10% and the 0.70 based investment fee, would you say that's standard across most funds?
Yeah, most of them you'll come in at under 1%.
Okay.
Now remember, fees are not everything, but they are important. I think anything over that 1% in total you'd want to be really sure that you're getting something back for that.
Yeah. And
some super funds I know might be 1.1%, which I think is a bit rich. But look, and I'm going to show you the next page if you want to build your own portfolio, like we talked about, what the fee does. But there's as an example, the Host Plus, which is, nothing wrong with Host Plus or the fund or anything like that. They've got a balanced indexed option, which has got Australian shares, international shares. It's all indexed. It's really cheap. And then they've got their default option, which has got Australian shares, international shares. It's got property, unlisted. Now, that's more expensive. But after fees, you would have had more money on the table with the expensive option.
Yeah, right.
Okay.
I don't get into these weeds much. Someone else does this on my behalf, gratefully. I wouldn't be changing super funds based on the fees.
No, and you don't want to. And for example, Johnny, before we hit record, John said your super and aim is on the Net Wealth platform, which is through a financial advisor, and they've got a portfolio that they've set up, blah, blah, blah. You will have these fees on Net Wealth. There will be a percentage-based admin fee. So regardless of what you invest in, if you rock up and put $200,000 on our platform or in Australian Retirement Trust or in Australian Super, Rest, Host Plus, anything, you rock up and put money on our platform, there's a fee.
Yeah.
Then you'll have an investment fee.
If there's not a fee, there'd be a concern, right?
Well, yeah, pretty much.
No one's working for free.
Yeah, and I will say, old wives' tale, there are no built-in hidden commissions in any investment product or super product in Australia anymore. Everything is disclosed and upfront.
That went out.
So let's have a look at the next slide. Here is the fee calculation. We won't camp on it long. If we had 50% Australian shares and 50% international shares unhedged, the fee's 0.08 because it's not actively managed, it's just automatically tracking an index. So 0.7 versus 0.08, the fee becomes in total 0.28%.
Right.
Okay? So a decent saving, but the question is, if you did this portfolio, you really can't compare the high growth because now your asset allocation is different. And this is where we need to have a cold shower when it comes to comparing super funds. You really can't say, well, my super fund is 0.28. Why are you paying 0.90? They're completely different investment options. And not only that, when you are comparing, so if you had Australian super high growth and ART or Aware Super or Rest Super or Uni Super, high growth, any of these companies, before you compare the fee, you have to line up the asset allocation. So what percentage is in Australia, what percentage is in international, what percentage is in property, because you need to be comparing apples with apples.
How many Australians would be looking at this stuff and saying, these are my fees? And
Probably just the two of us here.
yeah.
A couple of freaks and geeks out there as well.
Because it's pretty minor in the whole scheme of things, isn't it?
Yeah, like I honestly, if someone was just like, I'm happy with the high growth here, 0.7.
Yeah.
I'm happy with the super fund. I like their website. I like their app. Freaking get on with it and just shovel money.
And when you say like their website, might be an off-the-cuff comment, but what do we want to see on a website? Do we want ease of access?
Well, it might be their member portal is easy. They've got a nice app.
Yeah.
If I want to do a notice of intent to claim, they don't make me use a wet signature. Yeah. If I want to do a spousal split, I can do it to an external fund. It doesn't have to be the same fund. I'll go out on a limb. Most of the big super funds in Australia, they're going to be around the same fee and the same return. It's honestly just the vibe, for want of a better word, I think. And you can at me in the comments and all that, that's fine. But we've got a really good, robust super system here in Australia. So let's now have a look, John. We see it online when people ask questions, what is not a superannuation fee? Well, the first thing that isn't a superannuation fee is the contributions tax, because whatever different super fund you've got, could be CBUS, Australian Super, Aware Super, Uni Super, ART, Rest, Host Plus, some other super fund that no one's heard of, or you've got a self-managed super fund, you've got to pay the contribution tax to the government. So that's not a fund fee. The other thing that is not a fee is the insurance premiums, because they will vary, but with every separate person.
And there needs to be insurance premiums in there. That's
Well,
a priority.
No, I think that we'll get to we've got a whole section on insurance, but I just want to say when comparing super funds, you really can't look at the insurance premiums.
Yeah.
Because you want to keep your insurance separate to your wealth accumulation.
Yes.
You don't shat where you eat, John.
No, but what I'm saying is they come hooked on to every superannuation.
Yeah. Well, you can opt out and turn their default up, and we'll get to that. But strictly speaking, when you're comparing super funds in terms of fees, you just want to look at the admin fees and the account member fees and the investment fees, and you've got to make sure the investment fees that you are comparing lines up with a similar fund that has the same or very close asset allocation.
Yeah.
So another trap there, there's no real industry law to say that a high growth fund must have 80 to 90% high growth. So in the non-super world, a balanced fund will have 50% defensive and 50% growth. But in the super world, the word balanced could go, our balanced fund has 70% growth and 30% defensive.
And that's the confusing part about it for someone that's not in there day to day, is you look at balanced and you look at growth and you're like, hang on a minute, these results are very similar.
That's right.
What's happened here?
Yeah, and
that was meant to be conservative balanced.
And you could actually look at stuff and it's like, far out. This super fund's balanced option that has a lesser allocation to growth has done a better job over the last 10 years than this fund with a growth option that has 80% to growth.
Yeah.
Something's going on here. Fund here that has a higher growth allocation.
Yeah.
Maybe they're crap managers.
Yeah, I was going to say they're investing in the wrong assets.
Or the other super fund, maybe there's some stuff that they're flagged as defensive is actually not really defensive.
Yeah.
So
how much do you read into that? When someone says, look, do you want balance? Do you want growth? Do you want what the other categories are? Where do you treat that seriously, or you say, look, these are the kind of returns I would like?
Well, I think it's important to, and I want to educate people on having a look at their current superannuation option, seeing what their fees are, seeing what the asset allocation is in their option.
Yeah.
And it will be on the website, or you open your statement or log in, like you're invested in the growth option. Okay, I'm going to go click it, see what it says, how much money is invested in growth assets, shares, international Australian, private equity, property.
Yeah.
And you just got to know, you just need to start to learn what's what in this super world. Okay, beneficiaries. There are basically two types of beneficiaries in the super world. There's the CIS dependent and tax dependent. The CIS dependent, it's named after the Superannuation Industry Supervision Act, so the legislation. That's basically anyone who can get money from someone's super fund. So you have to be a CIS dependent. So you could be a child of any age, you could be a spouse, you could be financially dependent on the deceased, or in a person with an independency relationship with the deceased.
Interesting in that is adopted children as well as stepchildren.
Yeah, well, they're kids and family unit and all that, but that just comes down to your estate planning broadly. Now, the tax dependent, this is who can get money from super tax-free. So a spouse or former spouse, yep, they're ticked as a cis dependent. Yep, okay, now you can receive, Amy can receive your money from super tax-free, all good. Children under 18, so if you're under 18, you can get mum or daddy's super tax-free. Now, you can see a child is a cis dependent, but if you're an adult child, you're not a tax dependent, so you will pay tax on monies that comes from, and I'll use an example, John, you're my daddy, you've got $100,000 in your super, I'm your only child, I'm an adult, you died, I tick the box of a cis dependent because I'm a child of yours. I don't tick the box of a tax dependent because I'm over 18. So that means I will have to pay some tax. Now, this is where it can get complicated really fast. Remember earlier I talked about the taxable component, the tax-free, or the tax and the tax-free.
Yeah.
If I had a super balance of $100,000 and $50,000 was tax-free and $50,000 was taxable, if you did in your super account, when you died, the tax-free amount, I would get paid to me without any tax.
Because tax has already been paid?
Because it was put in by you with post-tax money, but the other $50,000 or the portion that's taxable, so on that $50,000 that's taxable, gets left to me, your adult child, I would pay 15% tax plus the Medicare levy, 2%, so 17% tax. There's a weird...
Maximum.
Yeah.
So
and this
nothing to do with your taxable income for that year?
No.
Straight 17.
However, there is a weird thing, and this is why advice and tax planning and estate planning is important. You can also put a beneficiary to your super fund as your personal legal representative or the estate. So remember, super doesn't fit inside your will, but you can tell your super fund to pay that money direct to your will. So there's no discretion by the fund, they just pay it into your estate. If you paid that money into the will and then I got that portion from your super, I don't pay the Medicare levy.
So I save 2%. So you're still going to pay the 15 regardless.
On the taxable amount if you're an adult child.
Yeah.
So again, this stuff can get messy fast. Let's have a look now at insurance. So we won't camp here too long, but basically you rock up to your super fund and they'll have some default insurance that, you know, the big super fund's gone to an insurance company and saying, we want to provide a death benefit for our members. So they'll negotiate a group rate, it's called group insurance, and that will be just tacked in. So if this was the ART super fund or your Aware or CBUS or whatever it is, you got your $63,000 on that account. You might have death, TPD, income protection or salary continuance. There you go. The problems are it's tied to that exact fund. So each 3 years, if the super fund re-tendered, the prices might go up, they might go down, the benefits definitions might become worse, they might cover you for less, all that stuff. It's usually more expensive in this climate than going to a financial advisor. The definitions, you know, I've talked about, they're not as strong as getting your own insurance tailored to you. But the big thing here is there is one beneficiary tied to the death cover and the super account. So on this slide here, if you had your $63,000 in super and you had the beneficiary to Amy, she would get this and your death cover. Right. Now, if you had a child from another marriage who was under 18, you might want to choose that they get your death cover and Amy gets your super balance. So it's just a little bit more flexibility, not having your superannuation tied to your insurance.
So what you're saying is inside your superannuation, the insurances are more expensive and less relative to you and your situation.
Yeah, so Sky Wealth has done a heap of data on this, and we had Phil on the show a while ago. We had actual examples that increasing cover through the group policy was more expensive than going through an advisor.
Wow.
Like it's wild.
Because a lot of Australians would naively just say, oh, I've got insurances in my super, I'm fine.
Yep. If you get a retail policy through a financial advisor, you can see here there's different dots. We'll say that that's CBUS Super. We just tell this policy to take the money from CBUS each year. I want to move from CBUS to Australian Super. Yeah, I've done that. Then I just tell this policy to get the money from Australian Super, not my CBUS. So it's just more flexibility.
Yeah.
You can get some good packaging. So if you've got your income protection, you might have a portion paid in super, portion paid outside. If you've got trauma cover, it can be cheaper linking it to death cover that's actually paid for the super fund. So a lot more flexibility. And like I said before, you can set a different beneficiary to the life insurance to the actual super balance.
No-brainer, isn't it?
Yeah. So, yes, a financial advisor, when they set up your insurances, receive an insurance commission from the insurance company for doing that. But guess what? It's still cheaper than doing a like-for-like with your group policy on balance. So, yeah, it's just really important to note. What else have we got here? So, some FAQs. Can you join super funds with a spouse? No, you can't. Unless you have a self-managed super fund. There could be some things where I'm pretty sure, like you and Amy with net wealth, I think a lot of these wrap accounts, and we'll put a link in the show notes and on the YouTube description to the episode I did with Vince about wrap accounts. You've got separate member accounts, but they would look at both of your balances and use both balances for the fee aggregate. So you kind of can have a bit of a win in terms of fees. Is super actually safe? Well, I believe it is, but this comes back to who's the trustee? Have they got a track record? We've heard some real sad stories of people losing, all their super funds from investing in various schemes and whatnot. It all comes back to a diversification play. We just don't want all our super in the one basket. So super is safe because it's just a tax structure. But what are you investing within that tax structure?
Like any investing, it goes up and down, and there are sometimes crashes. And if you need that money at that certain time, you are vulnerable. That's with any investing, isn't it?
Well, that's why we did the Retire Right podcast for people coming up to 10 years out of retirement. That's when you really need to start looking strategically.
Yeah.
Because remember, if you're 60 years old and stop working, your money still needs to go to work for another 25 years.
Yeah.
So, one of the questions is, what investment option should you choose? Well, one that is actually suitable to your goals and time frame.
Yeah.
And that's what I mean. If you're under age 50, I don't know if there's a reason not to have 80 to 90% growth.
Nah, but the thing that I always revert back to is, well, sometimes I can't see a difference between balanced and growth. So,
but that's where you need to look under the hood. You need to look at the asset allocation individually, the percentage asset allocation to growth, the standard risk measure, which tells you over the next 20 years, this will have 4 to 6 years of negative returns.
Yeah.
Forget the name.
Yes.
Asset allocation, standard risk measure, suggested minimum hold time. They are the three things that actually determine what you're invested in. It could be called the John Pidgeon BS fund.
Yeah.
That's cute. Doesn't mean anything. What are you invested in? What's the asset allocation?
Yeah.
and what's the standard risk measure and minimum hold time.
So continue to ask questions.
Yeah. How much do you need to retire? You need as much as possible. We will do another episode, I think next fortnight. We're going to do a campfire chat with Vince and Jess Brady from the Financially Fierce podcast, and we'll get into the weeds of everyone's other questions that they put up in the Facebook group. If you want to join the Facebook group and you're not in there, where it says, where did you hear about us? I heard John and Glen talk about Super episode 836 or whatever this one's called, so we know you're not spam. With the rules changing all the time, should I trust Super? Well, I'm saying yes. What are you saying?
I'm saying yes as well. But like anything, there's things that we can't control. Does that mean we just throw the toys out and just go and do something else? Well, what is that something else? As we said at the start, there's no better tax haven in Australia from an investment point of view than for your retirement than Super. So, yes, you got to roll with the punches of rules changing and everything else. But, yeah, I don't know if it's a trust thing. It's more of a well, I suppose it is trust with government and everything else. But
yeah, but I'm not a tinfoil hat guy.
No, and it's looking at the asset class probably more so, saying like the tax benefits combined with the asset class, am I on the right track? More so than, I can only put up to 300 grand in Super or whatever, and then it blows me up. Like,
yeah, and that's it. It's just a structure. Sure, there's potentially legislative risk. So 10 years ago, you pumped Super or you put $1 million in when they let you and all that, and now you've got your $10 million in Super and they're changing the rules. So over $3 million, you're going to get taxed more. Well, it sucks, but also
it's a fair chunk.
Yeah, but like if you've got $3 million in Super, I think you'd be okay.
And where it comes back to diversification as well. Did you actually have too much in there? Is there a thing? I don't know. Well, there is now.
Yeah.
Because you're impacted if you have too much in there now.
Yeah. And I will say, back to the contributions and the 15% tax that goes in on the contributions tax, if you earn over $250,000 a year, it's 30%.
Yeah.
Which is still less than
it's company tax, right?
50% in your own name. So on the contributions tax, maximum 30%. I think we can trust it. I just don't see any, because it's always going to be more tax advantageous than outside.
Yeah, and I'm probably guilty of this as well in terms of not so much trust, but just not being involved in it on even a year-to-year basis. I trust someone else outside of my family to say, yeah, you do what you think's best. And I think a lot of Australians are in that same boat potentially where they say, well, maybe I need to take more involvement. Maybe
do you know what your asset allocation is?
Not really.
Yeah. See, that's potentially a problem. You need to go back to your advisor and be like, hey, you probably have told me this, but
you
what's the percentage of growth?
Yeah. But I'm a little bit of an outlier in the sense that I've been running a business, started a few different businesses, so the contributions over those periods weren't great. So my superannuation is not, I'm not totally reliant on that like a lot of Australians.
And if I don't have a beneficiary, well, the trustee will gather information and data and they'll make the call who to pay it to. That was the other FAQ. But look, we haven't covered a heap of stuff in here. We've talked a lot recently on the podcast about spouse splitting, so I don't want to rehash it. Low income earner, put $500 of your own money in, the government will match it to $500. Anything else, John, that we may have missed that you want to make comment on?
Oh, look, the attractive thing for property buyers is the first home super saver scheme. So that's relevant if you're at that time in your life.
Yeah, and Vince and I did a full deep dive of that scheme. But I just wanted to do a bit of an overview. Did you learn anything today or?
Yeah, a couple of little things that
Like-
reinforced. I mean, it's
or did something stand out to you that?
well, something that stood out was I need to get back into understanding where my allocation is and what's actually happening there. And obviously, yeah, it is explained at tax time to say this is what we probably need to be doing. But yeah, it's definitely something that when I speak to a lot of people about, okay, what's their superannuation balance? Do they know their allocation? Very little of them know. And the listeners of the show here are probably, they're the converted. They probably already know this stuff. But reaching out to others to say, yeah, maybe you should check in on this yourself.
Yeah. So everyone, cold shower. You don't have to start a self-managed super fund and set up ETFs in there, and we'll talk about that next episode. But yeah, super is just a tax structure. Log into your fund, see what you're invested in. I don't think you need to have 50% in a conservative portfolio and 50% in a high growth. Just get a growth portfolio. Don't overcook it and keep it really simple. But I just want to drum home that it's all got to do with the asset allocation and your time horizon. That's everything with investing. So
Play the long game, let it do its thing.
that's right. Thanks so much for listening, everyone. John Pidgeon from the This Is Property podcast, and you've got a YouTube with your episodes on YouTube now, so you can check that out. Thanks, everyone. See you soon. Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.